Hello, today I will be presenting to you another case for the advanced audit and exam December session. Of course, this is something that contains topics and issues that could appear in other exams, for example, the March 2026 or June 2026 and so on. And this particular case focuses on ethical issues that arise, things like self-review threat or familiarity threat, having relatives that are at an audit client. And it's important to look at these types of cases because the AAA exam always has questions that are connected to ethical issues and problems, and they could appear in both Section A and Section B. So the case is called Rocky and Leslie. Rocky and Leslie are partners in a successful firm of certified accountants. The total fee income for the firm is $5 million. Last year, a branch of the large national firm Anders Atherson, opened up in the same town, and since that time, Rocky and Leslie have been losing business. Rocky has therefore launched promotional campaign via social media to try to win clients away from Anders Atherson. One of the key messages he has concluded in the campaign is that the offer of a fixed fee of audit for entities with revenue up to $500,000. So my advice here is when someone mentions fixed fee or variable fee, or maybe even in this case, I won't highlight revenue because it's not relevant, but fixed fee is something that in the ethical questions is something that must immediately highlight in your mind a red alert, because fixed fees are connected to lower quality of the engagement. Because if an engagement requires more people, more time, more resources, for example using an auditor's expert, the fixed fee will not work because you need more money to fund the audit. So fixed fee is something important here. So moving on, Leslie has been reviewing outstanding fee income. He has noticed that one of the partnership's clients, Virgo, owned by Rob Branston, has still not paid the previous year's audit fee. So this is immediately connected to giving credit to the client who hasn't paid, and potentially performing a more optimistic review this year with a better audit opinion in order to motivate the client to pay back. So when the previous year fee has not been paid, basically this creates a self-interest threat, because you would, as an auditor, be motivated to be in a better relationship with your client, so they pay you back what is owed. Rob and Leslie are very good friends. Leslie is sure that Rob would not default on the fee. So just because Leslie is sure is not relevant. Being sure that doesn't really weigh anything, and them being very good friends could be connected to self-interest and familiarity threats. So that's why I'm highlighting it. In reply to the promotional campaign, a lottery company called Winners has approached the company requesting the firm to act as its auditor. Winners is a large company which currently runs the Florida lottery and is also tendering for the national lottery contract. Rocky is immensely excited about this opportunity as the audit fee is likely to be in the region of $500,000. As well as the audit, Winners Company would like Rocky and Leslie to supply other services, including accounts preparation, compliance monitoring. So when a company wants you to do other services, it is a very tricky area. If it's a group audit, it is absolutely forbidden to provide other services, especially account preparation, compliance monitoring, internal audit services, and so on. In this case, the company is not mentioned to be listed, Winners, so it's most likely to be private, and Rocky and Leslie would be able to provide these services. However, below we will look at what are the safeguards that need to be applied. Leslie has two adult daughters. Both work for Rocky and Leslie. Sophie, who has worked for the partnership for 7 years, has recently taken out a mortgage with Midwest Bank, which is an audit client of the partnership. So basically, an audit client provides a mortgage to one of the daughters of Leslie, which is, as we said, one of the certified accountants in the company. So this is important. This is self-interest and familiarity threat right here. Maggie, Leslie's older daughter, has only recently joined the partnership. Up until 3 months ago, she was the financial accountant at Pet Foods Company, which is also an audit client. Leslie feels that Maggie's knowledge of this client will be a great help and is intending to use her as the manager on this year's audit of Pet Foods Company. Maggie's husband, Sid, owns $100,000 worth of shares in the company. So again, the husband, the pet foods, all of this is relevant, and we'll see in the answer below why. Generally, when it comes to ethical questions, any relatives taking loans from bank, it must immediately click in your brain that this will be relevant to the question and to answering it. So if they mention these highlighted things here, you must include them in your answer to have some chance to get 1 or 2 or 3 or 4 extra points. And these few extra points, by including these highlighted things, is going to be the difference in some of your cases between passing and failing the exam. So, what is required? Comment on the practice management and ethical issues presented by the above scenarios. So, I think the ethical issues is going to be the main emphasis here, but we're also going to look at the practice management. So this is an example solution. So this isn't the best solution or the perfect solution. It's just an example that I believe works. The fixed fee is acceptable. However, fixed fees are not generally wise, as the auditor is unable to assess the amount of work required until discussion with the client has taken place. Fixed fees may reduce service and quality if insufficient time can be devoted to the audit, and losses may be made if problems occur that cannot be covered by the increasing fees. An alternative basis may need to be considered by the firm to maintain quality and manage clients' expectations. So again, the potential client winners, the audit firm does not know what are the resources, how much time, how much people, any specialized software, or anything else might be needed by the audit firm in order to conduct an audit. Therefore, creating a fixed fee or a fixed maximum fee is something that could create an issue. And no client would like you to call them in the middle of the audit and say, well, the audit resources are higher. We would need to increase your fee by 5 or 10 or 15%. And it wouldn't be very ethical to use a fixed fee because it could get you in unpleasant conflicts with your client. So the next issue is the outstanding fee from Virgo. The outstanding fee income is similar to making a loan to a client, as I said earlier. It may create a self-interest, as the firm may choose to ignore issues relevant to the audit until it has received its own overdue fees. So why have I highlighted the yellow, excuse me. So why have I highlighted the yellow part here? Because in the exam, you will not be required to write the ISBA code paragraphs, the international accounting standards, the international financial reporting standards. You need to know what they say, but you can use the book and the revision kit to learn it. You don't need to go into the website of the international accounting standards and read them, which is great. And if you remember, for example, that this code refers to this issue, even if you write what I highlighted in yellow, you will not get any points. You get 0 points for quoting particular standards. The reason why I wrote it here and the reason why it's mentioned in the revision kit and the other books and so on is because it's professional to refer standards to the particular code. But in the exam, no one expects you to write like this. Nobody expects you to refer. They expect you to know and simply write in words and numbers. You don't have to write the codes. If the fees are overdue, the firm should consider whether to continue. Therefore, prompt payment should be encouraged. There is an implied familiarity threat to objectivity presented by the friendship between Rob and Leslie. However, this is neither immediate or close family. So they're friends. So that doesn't really mean anything. So if they're friends, it's fine, it's more superficial. But if they're family, it's considered that they're so close and they will be so interested in working together that there will be a potential conflict of interest here and implied familiarity threat. Because in this case it's only a friend, you can apply more superficial safeguards. And I have seen this in my work because I have worked as an auditor. And an example is to have an independent review of the Virgo audit. So a partner inside the audit firm will review the audit, and they will perform an equality review, and they will give their advice if it was performed properly and if anything needs to be changed. But this is something that the audit partner does have to keep in mind. But in this case, because they are not asking you what safeguards should be applied, you don't have to list 5 or 6 or 7 safeguards. No one is asking you about safeguards here. So including one just shows that you know what you're talking about, and you're going to get a full point. But if you give a list of safeguards and you just wrote what you have learned from your book, you're not going to get any points. You don't get points on quantity, you get points on quality answers. So the next issue is Virgo and winners. The lottery company tendering for the same contract as Virgo would constitute a conflict of interest for the firm if it wishes to act for both clients, as this is a major contract and their competitors. This could also present confidentiality issues regarding sensitive information about the tenders for either client. So this is an issue that sometimes arises in AAA exam. You would be an audit company and you have 2 clients. One client might want to purchase shares in the other, or both of them would want to participate in the same tender. And as an auditor, you could influence each company's final audit report, and therefore whether they win a particular tender or not. So in these cases, you have to apply safeguards, and here they are listed just informatively. Winner's company appointment could be accepted providing both parties are informed, both parties are in agreement that the situation is acceptable, so there needs to be an agreement between them officially signed. Different audit teams, this is crucial. Different audit teams should be used for each audit. Information should not be transferred between teams, so should not be transferred. I'm definitely highlighting it twice. Reviews are carried out by different partners to choose to those involved in each audit. So basically, this is not an obligatory safeguard. You would get enough points for the above ones, but this is technically good to do, but in a real world scenario, it may not necessarily be, and audit partners would be too busy to do this. But if you have 2 separate engagements on 2 separate clients that are competitors, it would be wise to give 2 separate partners the job of performing a quality review. However, because I don't think this works in practice, I don't think engagement partners have the time to do this. Personally, I won't write this last question, and the previous 3 would give you enough points if you had to give a list. In section B, you're likely in the first question to make a list of ethical issues and to list safeguards. Usually 2 or 3 is enough for the AAA exam. Next one is winner's fee income. The ACCA and AISBA only set fee thresholds for public interest entities, and in this case, the threshold is 15% of the firm's total fees for 2 consecutive years. Again, in yellow, you don't have to write it. If you write what is in green, you get points. You're not going to get any points for quoting the code. Before a self-interest threat starts to emerge, guidance in the UK is that the maximum fee income from one client should not exceed 15% of gross recurring practice income, but this reduced 10% if the company is listed or other public interest entity. So because the company is private, in this case the percentage is higher, it's 15. The winner's fee currently only represents 10%. However, there are 2 issues here. We need to determine whether winners is a PI or public interest entity due to being a lottery company, and not just because the size or the status. So if it's a pension fund, a lottery company, a bank, then it's a public interest company, and it doesn't matter that it's private. it would influence society. Therefore, it is a PI, a public interest entity. So in this case, this could present an issue because if it is decided internally by the auditors that Winners is a public interest entity, then 10% of income would be an issue, and a quality review would have to be done because if it is 10 or could potentially increase more than 10, because as we said, fixed audit fees are not necessarily something that is going to be maintained, then this safeguards that you should apply are either to refuse the engagement or accept it, but also find other clients so the portion of winners is less in the overall income of the auditors. So these are the two safeguards that you could apply. In this case, the answers I've written are: we need to determine whether winners is a PI, and other services are required, presumably on a regular basis, which are likely to push the fee percentage closer. Although there is no imminent self-review threat, it is necessary to take extra precautions such as disclosing this issue to those charged with governance at Winners Company and perform an external review of the engagement. So when there's problems or issues connected to the final auditor report, and I'm going to highlight this in a different color, you should disclose this to those charged with governance. I like to underline that those charged with governance, sometimes it doesn't say what the company is. It just says those charged with governance. And some students don't know this, but those charged with governance is always referring to the audit client. So these are people governing the audit client. They are the board of directors of the audit client. They are not inside or running the audit company. Okay, so Rocky and Leslie, in this case, those charged with governance, are not inside the company. They are at the client, Winners. Additional services. In addition to the fee limit issue, the auditor should consider the amount of fee compared to the audit fee that could create a self-interest threat. For example, would Rocky and Leslie be inclined to not modify the auditor's report in order to please the client and retain lucrative other services? Whether Rocky and Leslie have adequate resources and expertise required to perform the additional services. For example, do they know enough about lottery regulations? Do they know enough about what is required to account for these type of companies? Do they have the enough people inside the company to perform the engagement? The fundamental principle of professional competence and due care is key issue here. So you need to apply professional competence before accepting the engagement. And again, this is something that's high level. It's decided and thought about by the audit partner, by someone that's very experienced in auditing. This is someone that's been working at least 10 years as an auditor, and this is something that definitely no junior or intern should do. Something that I could have added as an examiner is, for example, I would have put a junior in this situation, and I would have said, okay, the audit partner told the junior to work on the engagement of the lottery, and they should work on the regulations. However, a junior in an audit team cannot work on a lottery company because regulations are complex, and because usually in audit companies, the audit team doesn't work on the regulations. They have a separate law and legal and compliance team that works on regulational issues. So in that case, if that hypothetical situation happens, that means the audit partner did not do their job properly and the engagement quality is potentially low. So, but again, that is just something that I quickly added as something that I would have put in order to make it difficult for the student. Finally, Sophie and Maggie. The issue here is close but not immediate family connections that could create a familiarity threat. So we're basically giving the benefit of the doubt. We're not saying that they're close. We're not saying, oh my God, there's a definite familiarity threat. We're saying there is a close but not immediate family connection. So we're giving the benefit of the doubt, and the examiners like this. That means that you are applying professional judgment for which you get points. The risk is that the auditor may not be, I'm going to change the color. The risk is that the auditor may not be willing to issue a modified audit opinion to someone they are closely attached to, either business or personally. So this is something that applies both to audit and advanced audit exams. Always explain your point. Okay, this is an issue. Why is it an issue? This is the procedure. Why is the procedure? This was a bad decision by the partner to put a junior to work on working inventory. Why is it an issue? Because juniors are not experienced enough to audit things that are based on subjectivity or complexity, like work in progress or valuation of a loan or a valuation of a machine, an asset, and so on. So always explain why. The examiners give extra points for explaining why. Otherwise, you lose on important marks. Again, what's highlighted here does not need to be written in the exam. No one expects you to write laws in the exam. Under the ACCA and code, there appears to be no self-interest threat regarding Sophie's mortgage. So it's nice to write who the mortgage is to and what is the amount, because that shows you're referring to something specific. Okay, in the exam, be specific about what you're writing about, and that way you're making it easier for the examiner to give you points. So, no self-interest threat regarding Sophie's mortgage as long as the loan from Midwest is on normal commercial terms. So whenever you hear someone from the auditors or someone close taking a loan from a bank, it must be on normal commercial terms, unless if it's not on normal commercial terms, then there's a potential self-review threat. So depending on the scenario you get in the exam, if you get such a question at all, you will need to explain whether in this case there is or there is no self-interest threat. In this case, we don't know her Sophie's contract with the bank. We don't know what are the terms. But if the company if the scenario specifically says this person took a loan on very beneficial terms or bought a luxurious house for $10,000, which is nothing for a luxurious house, then this definitely suggests self-review threat and that the quality of the engagement could be low. Maggie cannot be manager on the audit of pet foods company until 2 years have elapsed. So 2 years is the cool down period. Since leaving the company. Otherwise, she may be auditing her own work, and no safeguards could reduce the familiarity, self-review, and self-interest threat. So she could start working at the current company, the company that audits pet foods, but she cannot work on the engagement of the pet foods company. So it's different. These are two different things. There's a difference between working for an audit company and working on a particular engagement. In this case, if she doesn't work on this engagement, she doesn't have access to the data, the working files, the meetings. So officially, it won't be a problem. But if she worked for the same company that she used to be an accountant for, and 2 years haven't passed, then there are no safeguards, and that means that either she needs to be fired or moved to another team, or the engagement needs to be cancelled. Final paragraph. Despite Sid and Maggie being immediate family members, Sid's shares should not represent a self-interest threat. So Sid was her husband and do not require disposal because she is not to be involved in the audit. Again, because she is not to be involved and she should not be involved, her husband should not dispose of shares. But if she was involved, her immediately family member, whether it's husband, brother, sister, mother, or father, must not have any shares, or the shares must be very material to the company's overall market capitalization. Should Maggie subsequently be involved in the pet foods audit, then Sid should dispose of the shares. So overall, this is the question and the answer that is suggested. Again, this is not the best answer. So if you have any questions, please write in the comment section below. I do offer a tutoring, so if you're interested, please write. And hopefully I explained it well enough. Ethical questions are definitely going to be in the exam, so use this as something that is a reference to what you could potentially get. But remember that questions that already exist and answers that already exist will not appear on the exam. They always write things that you have never seen before and that require quick thinking and imagination on the spot. And the key to that is just practicing mock exams, practicing questions. Practice makes perfect. Thank you for watching.